Welcome to this Killik Explains finance video. This week, big decision, lump sum or regular investing. Which is best? Well, here's your basic dilemma. You want to invest £12,000. Your basic choices are invest the whole amount up front in one lump sum or drip it into the market on a regular basis. Let's take a look at those two. Now, the lump sum approach. The full £12,000, as it suggests, is invested right now, and let's say it's invested for 5 years. Now, stock markets have tended to rise over the long term. So let's assume stock markets rise over this shorter period too. And let's assumption, not guaranteed, just for illustration, that you could earn 5% per year while your money is invested. Not promising that, just giving it as an example. You would have roughly £15,315 at the end. So £12,000 up front, a little over £15,000 at the end. So remember that number. Now, let's drip feed it. To drip feed it, we're not going to do £12,000 at once. Let's do £200 per month, and let's do it for 5 years. Let's say, again, the stock market rises as you're dripping your money in. Let's say, again, you could earn 5% per year. Where would you be? Well, after 5 years, you've done okay, but this time you've ended up with more like £13,618. So you might think game, set and match to the lump sum approach, but actually it's not quite that simple. Weighing it all up, the great thing about drip feeding is you can just drip in smaller sums. Some people just can't afford to do lump sum investing. Secondly, if you set them up as regular payments, your drip feeding is automatic, it happens in your sleep, you don't have to remember it, you don't have to panic around the end of the tax year, it's happening. Thirdly, it may reduce what I call the prevarication risk. Once you've set up a drip feed, you don't have to worry about, has the market gone down today, has it gone up today? Whereas lump sum investors do fret. They might get the timing wrong. And if they are unlucky, that can have a big effect on their overall performance. Invest today and the market crashes tomorrow. The approach needs to be systematic, that's for sure, whether you're a lump sum or drip feeder. The effect on asset allocation short term is something to bear in mind if you're going to drip feed. If you've got a lump sum sitting there and you're thinking, no, I could invest it today, I'm going to wait, bear in mind that means your asset allocation now includes some cash, and that may disturb the balance of your portfolio if it's split bonds and equities, let's say. And finally, regular amounts should be adjusted over time. Don't forget that if you're dripping into the market, inflation means that you ought to be increasing the amount you drip feed in as you go. So, food for thought. But that makes the point that there are some things to weigh up. It's not just a simple case of looking at the numbers. Now, going back to the numbers, a 60-40 stock and bond portfolio in the UK market from 1976 to 2015, according to Vanguard. Basically, if you'd gone lump sum, you would have outperformed 70% of the time, looking at individual annual performance periods. Monthly drip feeding at any starting point would have given you 32% outperformance, or 32% of the time, and the average annual size of the outperformance doing a lump sum versus drip feeding or vice versa is around 2%. So what they're saying is around 2/3 of the time, or a little over, you do get a better result from lump sum investing. But before you think, well, there we go, there's another, there it is, that's what I need to do, bear in mind that in a volatile market, the picture changes in favour usually of drip feeding. So to illustrate this, imagine you've got unit prices at which you can go into the market of 5, 4, 2 and 4, and then we finish with a unit price of £5. So that's a series of years or investment periods. You've got a lump sum to invest and you decide to just go in at the start when the unit price is £5. Well, £1,000 divided by 5 is 200 units. You hang on to them. You've done your investing. At the end, you'll still have 200 units. All right, and we're saying, well, they're worth £5, so you're back to £1,000 if you like, you're fairly static. So what? Well, how do you drip it? Now, to drip in, you'll have to divide the £1,000 up into chunks, £250, let's say, and go in at the start, period 1, period 2, period 3, then stop, and the end valuation is still £5. Where would you be? Well, you would get 50 units off your first £250 at £5 a unit. 62.5 off your second £250, 125 when the price is only £2, you can buy a lot more of them with your money, 62.5 when the price recovers a bit, and then at the end you've got 250 units worth £5 each. So you've got more units and they're worth more money. So that's the point. In volatile markets, the drip feeding approach actually wins mathematically, if you like, as opposed to lump sum investing. So quite a few things to weigh up in terms of which approach will ultimately be the best for you. Any questions on that? Editor@killik.com, and to see related videos, killikexplains.com.